Hello, my name is Ray Franklin. Today's video is a summary of my June 24th energy update, in which I will explain why, based on what has happened since 2000, we are likely still early in the present cyclical bull market. I focus on natural gas in my videos because it's the largest source of power for the generation of electricity. Therefore, their pricing is highly correlated. Our May 20th energy update explored the three factors that strongly suggest that the average price of natural gas and electricity will be higher long term. And based on what has happened since 2000, we are likely still early in the present cyclical bull market. As you can see from this chart, since 2000, when natural gas trended higher for 2 to 4 years, they were classified as cyclical bull markets, and they were always triggered by unsustainably low prices. Now, prices were unsustainably low when they declined below the cost of production, and producers responded by making strategic decisions to curtail production to support higher prices, which we fully explained in our February 26th energy update after prices dropped to historically unsustainably low levels this year. The Baker Hughes' most recent report, released on June 21st, continues to confirm that producers are decreasing their production, with active gas rigs down 25% from this time last year, going from 130 to 98 active rigs. Producers decreasing production was an important factor influencing the length of cyclical bull markets starting in 2001, 2012, 2016, and 2020. In the past, the initial response of America's producers responding to those low prices was decreasing active rigs, and then increasing active rigs when prices increased, and this was an important factor determining the length of a cyclical bull market. And although producers' response to high and low prices is still an important factor determining the length of cyclical bull markets, in our May 6th energy update, we introduced a second factor that potentially will extend the length of our present cyclical bull market: increased exports of liquefied natural gas overseas and increased pipeline exports to Mexico. To put into perspective how much increased LNG exports overseas and pipeline exports to Mexico will impact our natural gas supplies, in our May 6th energy update, we pointed out the Energy Information Administration's, that's the EIA short-term energy outlook, forecasted that net exports would increase from 13.6 billion cubic feet a day in 2024 to 16.4 billion cubic feet a day in 2025. If the EIA's forecast is correct, the result would be our net exports would increase more than 1,000 billion cubic feet a day in 2025, and our present 560 billion cubic feet surplus would become a deficit in 2025 and support higher natural gas prices longer term. In our May 20th energy update, we also pointed out another factor that could impact natural gas and electricity prices shorter term. NOAA is predicting summer temperatures will likely be higher than normal throughout most of the United States, and AccuWeather is also forecasting a very active summer storm season. A warmer than normal summer would increase the demand for natural gas and electricity, and a major hurricane could disrupt the production of natural gas, which would further deplete our supplies of natural gas, leading to higher prices shorter term. Although no one can predict with 100% certainty what this year's summer will be like, most major forecasters are predicting as we transition from an El Nino to a La Nina condition, the result will be warmer than normal temperatures this summer, with increased hurricane activity. In our May 6th energy update, we warned natural gas would likely continue moving higher as the market anticipated production cuts, increased exports, and a warm summer with increased hurricane activity. And as you can see in this chart, natural gas has been moving higher while maintaining a pattern of higher highs and higher lows. This is a classic pattern early in cyclical bull markets. And given NOAA's most recent forecast of very warm temperatures through July 4th, prices will likely continue moving higher from present levels. Therefore, based on what has happened since 2000, along with the three factors discussed in today's report, we are likely early in the present cyclical bull market. And the longer you delay securing fixed rates, the more you'll likely pay later. Not every client's risk tolerance and hedging strategy are the same, but hopefully today's report will help put into perspective your risk-reward opportunities. We invite you to call one of our energy analysts to help you plan a hedging strategy that would be appropriate for your situation. And until my next report, please take care.